Good afternoon and welcome to today's webinar, Key Considerations in SPAC IPOs and DeSPAC Transactions with Major Lindsay in Africa and our guest from Weil. My name is Heather Nielsen and I work on the marketing team here at MLA. I'll be in the background answering any technical questions that you might have. If you experience any technical difficulty at any time during this webinar, please submit your questions to me in the Q&A panel and I'll be happy to assist you. Before I hand this over to my colleagues, Brian Davis and Dimitri Mastrocola, I'd like to run through a few housekeeping items. You should all be able to see the screen right now and hopefully hear my voice. All attendees are in listen-only mode for the duration of the presentation, and as a reminder, the call is being recorded. The recording as well as the slide deck will be available on our website in the next few days. Today's webinar will be approximately 1 hour, including Q&A. You may ask a question at any time throughout the event, and we encourage you to do so. At the top right of your screen is the GoToWebinar panel. Just open up the console, type a question, and hit submit. Your questions will only be visible to me and the other Weil partners, but not to the other audience members. We'll try our best to respond to them during the presentation. We will launch 2 quick polls just to get an understanding of your level of SPAC familiarity and help us with the conversation. This is our way of knowing more about the audience and your SPAC related experience. At the close of today's webinar, a survey will pop up on your screen. We hope that you'll take the time to fill it out. If you don't have time to complete everything, just please fast forward to the last questions. Brian, Dimitri, and I are dying to know when you're willing or ready and able to join us back at the Princeton Club in person. Lastly, before we get started here, I just want to let you guys know that we are offering CLE. In the handout section of the GoToWebinar console is both the attendee form and the survey form. As a reminder, we will send them to you after the call as well. And we will also read a CLE code about 3/4 of the way through that you will need in order to get CLE. Also on the GoToWebinar viewer, you can change how you see us. You can either watch active viewer or just the speaker or everybody at the same time. Before I get to it real quick, as I mentioned, we want to do a quick little poll just to see what your understanding of SPACs are. So first question we have is, have you been involved with or affiliated with a SPAC sponsor? And if you can vote for me, that would be appreciated. So it's either yes, no, or unsure. And I've got about 60% voted, so if you haven't voted already, if you want to just click the button and do so, and then I'll show the results to our panelists. Okay, let's show this one. So we've got about 36% that said yes, 62% no, and 2% unsure. And then the next one last little poll. Have you been involved in selling a SPAC? In selling to a target company to a SPAC, excuse me. Have you been involved in selling a target company to a SPAC? Yes, no, or unsure. And we'll give it another second or two here. I appreciate you doing this. Just helps us guide the conversation and also know who's in the audience since we can't obviously see you. So lastly, let's share the answers there. And we have 20% yes, 80% no. This one, no, unsure. So let's hide that. And now I'm going to turn this over to my Major Lindsay in Africa colleagues, Brian Davis and Dimitri Mastrocola, to answer your questions and introduce our guests. Excuse me, sorry about that. To introduce our guests from Weil, and we'll get this event started. Thank you.
Thank you, Heather. My name is Brian Davis. Also on the panel is my partner, Dimitri Mastrocola. We are both partners in the New York office of Major Lindsay and Africa, the world's largest legal recruiting firm. Both Dimitri and I focus our practice almost exclusively on financial services, particularly on the buy side, as most of you know who've attended this event over the last 13 years. One thing that's important is we're trying to figure out when we can go back to doing in-person events at the Princeton Club. Heather Nielsen is going to send out a quick survey asking you when you feel comfortable coming back. Literally an hour ago, I saw a release from the CDC that now says that meetings for fully vaccinated people, although it's a small crowd, are fine without masks. So we're hoping that there'll be, this will all accelerate and we'll shoot to get back in live mode as soon as possible. These webinars are great, but I think everybody misses the in-person contact. I want to thank Weil for sponsoring the event. As I said, this is our 13th year. This is the first visit from the good folks at Weil. And both Dimitri and I are very, very grateful for them taking the time to make this presentation. And finally, as everybody knows who's attended these events in person, I always encourage people to interrupt, ask questions. So you can't literally interrupt, but you can ask questions. The more active these events are, I find the more interesting they are and the more fun they are. So please don't be shy. You have 3 Weil partners who are ready, willing, and able to answer any question. And they've promised me that they will not send you a bill, no matter how many questions you ask. So please shoot ahead. It makes it so much more interesting. Finally, I'd like to turn the mic over to Heather Emmel, a capital markets partner at Weil, and she will introduce her partners. Heather?
Thank you, Brian. Hello, everyone. Thank you for joining us today on a, I think, very timely topic. SPACs have been garnering a lot of attention over the last year and a half, really, but recently, probably even more so. So I'm sure you've heard about them in one venue or another. And today, presenting with me will be 2 of my partners in our private equity practice, Krpata and Doug Warner. As you may know, the SPAC really consists of 2 distinct phases. The first phase is the initial public offering, where the money is raised, and that involves me primarily on the capital market side, since that's a securities offering. And on the second piece of that is selling, either in the target sense, selling a company to a SPAC, or if you're the SPAC, acquiring, doing your business combination, and that's where Kyle and Doug come in. So that's how we're sort of dividing today's presentation. We can go to the next slide. So for the agenda today, we're going to break it up into 3 topics. First, I'm going to speak about trends and innovations we are starting to see in structuring SPAC IPOs. I'll also spend a little time based on the feedback from the questionnaire at the beginning, covering just some of the basics of how SPACs work, primarily around the sponsor economics and structure. And then we're also going to cover, Doug and Kyle will cover the key considerations if you're a SPAC buying a target company, and on the flip side, if you're a target company selling your portfolio company to a SPAC. We can go to the next slide. Next slide. So this just provides, I thought would be helpful to start just to set some of the context for the reason that you're seeing so much press about SPACs. This data is as of March 31st. And if you look at the chart on the left, just in terms of the number of SPAC IPOs that have priced, when you look at the first quarter through March 31st, you had 297 SPAC IPOs that were completed. That's a staggering number, even if you're looking at the increased volume that we started to see in the 3rd quarter of 2020 and the 4th quarter of 2020. When you look just at Q1 alone, we had an extremely large number of IPOs, both in the market and also pricing. And on top of that, as of March 31st, even though we had such a large number already complete, we still had 255 SPAC IPOs in various stages of registration with the SEC. The chart on the right really just shows that the volume in terms of what the SEC is seeing in terms of IPO filings, the IPOs related to SPACs far outpaced the non-SPAC traditional operating company IPOs just in terms of filing volume. We can go to the next slide. So just to go back to basics for those of you that aren't as familiar with SPACs, SPAC stands for Special Purpose Acquisition Company, and it's really a newly formed blank check company that's formed for the sole purpose to go out and raise money in an IPO in the equity capital markets. It's a listed company. They're mostly listed on NASDAQ or NYSE. It has real governance. It has a board. It has committees, all the typical features of a public company that you would expect to see, except that it doesn't actually own anything, doesn't have any operations. Its sole purpose is to raise money to put aside into a trust to go out and seek a target company to acquire. It's important that at the time of the IPO, the SPAC doesn't actually have a particular target in mind, because the disclosure in that prospectus is very different than a blank check company that's really going out to raise money to acquire a company. Sometimes you'll see SPACs that are focused on a particular industry sector. So they may say, we're going to go out and seek a target in the healthcare sector or something else. Some SPACs are just general SPACs that they're looking for a certain size target company based on the size of the IPO and the valuation of the company that they're seeking to acquire. And as to the sponsors of these SPACs, they're most often private equity funds, but you may also see industry executives such as former CEOs that have industry experience in a particular sector that want to go out and do something continuing in that sector. At the height of the SPAC craze in the first quarter, we also started to see some celebrities get involved and form their own SPACs. So you never know, but it's primarily private equity sponsors historically. We can go to the next slide. So this chart just shows a little bit about the key SPAC terms. So when the securities are sold at the time of the IPO, it's actually a unit, and that unit consists of a common share and a fraction of a warrant. The units are virtually always sold for $10 per unit. That's just typical SPAC pricing. All of that is pretty much set up front and followed largely, in the market by every SPAC. All of the proceeds are placed into a trust, as I mentioned earlier, to be used either to complete a business combination or to potentially redeem the SPAC stockholders' shares. So one of the key features of the SPAC is that you invest up front, not knowing what company the SPAC is going to acquire. And at the time the SPAC solicits the stockholders' vote on the transaction, the stockholder has the opportunity to decide, do they want to stay in this transaction and own stock of the newly public company, or do they want to get their shares redeemed? And so the trust proceeds are there for that purpose, and they effectively get their money back if they elect to have their shares redeemed. The warrants are actually separated at some point post-IPO, and the units continue to trade as units, but they also separately trade as common shares and warrants. And so as a result, even shareholders that elect to have their stock redeemed in connection with the business combination do get to keep their warrants. Those don't get swept up in the redemption. The warrants typically have an exercise price of $11.50 pretty much universally. As I mentioned, the unit includes a fraction of a warrant, so you usually see a half or a third or a fourth, or for some of the serial SPAC issuers, a larger fraction. They're generally not exercisable until at least 30 days post-business combination and also 1 year post-IPO. So depending on how quickly the SPAC is doing a deal, it could be that the warrants aren't actually exercisable for some time. And they're typically exercisable for 5 years. They do also contain some redemption features. There's a forced redemption or forced exercise provision if the shares are trading above $18 for a certain number of days. The company will have the ability to effectively force an exercise. Otherwise, the warrants would get redeemed at a penny. And there's also often in a lot of these deals a warrant redemption grid. If the shares are trading between $10 and $18, then they can effectively force a redemption and issue shares based on a pre-agreed pricing formula. But effectively, without doing business combination, the warrants are worthless. We can go to the next slide. And this just also shows the key parties to the SPAC structure, SPAC being in the center there in green. The public shareholders, as I mentioned, invest cash, get their units. That cash is placed in trust. We haven't really talked much about the right side of the chart yet in terms of the sponsors. And we're going to spend a little time going through, what their economics are in the SPAC and how they make their investment. You can go to the next slide. So the sponsor vehicle is usually capitalized with a nominal investment by the sponsor or sponsors of the SPAC. It's always $25,000 for their upfront investment, and this is effectively their promote. So this is the interest that they receive for putting together the SPAC and going out and sourcing and finding ultimately a business combination. So they get a special class of shares we often refer to as Class F shares for founder shares. Sometimes it's Class B, but it's a separate class from the shares that are part of the units that are sold in the IPO. those founder shares do convert at the time you do the business combination into the public shares. So ultimately, that's what they'll own. And the way that this is structured typically is that the founder shares are intended to represent 20% of the post-IPO capitalization. So this is relevant to one of the innovations that we're going to be speaking about in a little bit. We can go to the next slide. The other key feature for the sponsor investment is they also acquire private placement warrants. And the reason that they put this money in, this is their real at-risk capital. They purchase these warrants to fund certain costs that the SPAC incurs, because it otherwise, as I mentioned previously, is required to take all the proceeds of the IPO and leave those in the trust for the future business combination. So it really doesn't have any other resourced capital. So these private placement warrants fund some of the initial offering costs. They fund a nominal amount of working capital that sits outside of the trust for expenses that the SPAC will incur while it's seeking a business combination target. And they also fund the portion of the underwriter commissions that are paid at the time of the IPO, which is usually 2% of the size of the offering. So the amount of the warrants that the sponsor will purchase varies based on the size of the deal and the expenses for that transaction. But this is a key feature of how the SPAC actually has money to pay for the offering and some of the ongoing expenses. We can go to the next slide. So now to the trends. I'm sure you've all heard about recently the SEC focus on the warrant accounting for SPACs. The SEC very recently, in the last couple of weeks, came out and called into question the industry-wide practice of all SPACs that accounted for both their public warrants and their private placement warrants as equity. And the questions really were based on certain features and terms within the warrant agreement for that particular transaction as to whether it met the criteria under the relevant accounting literature to properly be treated as equity and not a liability. So one of the implications of this statement is that all of the SPACs, whether they're in the stage of, not yet IPO'd, but had started the process, recently completed IPO, but not yet found a business combination, those that have announced a business combination that hasn't yet closed, or even former SPACs where the business combination is complete and is closed, are all having to go back and look at the terms of these warrants to see if they have any of these provisions that may result in liability accounting, which is, an unprecedented in terms of just the, based on the numbers we talked about earlier, the sheer number of SPACs, not to mention all of the SPACs that had been completed, prior to the increase in new IPOs. And we're really seeing, unprecedented cooperation among accountants and lawyers trying to work through this together. But it, needless to say, has caused severe disruption in the market until everyone gets their arms around the implications of this. And ultimately, there will be a large number of restatements, most likely just based on the common features that are in the typical warrant agreement. Even prior to this SEC focus on warrant accounting, we had seen a slowing of the market in early April. Just based on the fact that it's so saturated and there's so many investors that are heavily invested in SPACs or in the pipe that's often raised in connection with the business combination. So we had started to see a little bit of a slowdown, but this obviously changed the landscape dramatically. So one of the innovations that we were starting to see even prior to the SEC's focus on warrant accounting is in some SPACs, and I think it started primarily in the biotech-focused SPACs, but also some of the repeat serial SPAC sponsors were starting to eliminate warrants completely. Obviously, there's potential dilution that no one likes as a result of the warrants, and they had enough of a track record in some cases for the repeat SPACs that they were able to sell the IPO, to the market without the additional benefit of including some warrants. So that was something we were starting to see. Remains to be seen as a result of the focus on warrant accounting, if we start to see more of that, or if people just try to focus the terms of their warrants to avoid liability accounting. The other innovation that we started to see is something just I'll refer to as the alignment share structure. There were not many of these, but we were starting to see variations on this where instead of just getting the single class of founder shares at the time that the sponsor invested the $25,000, there would basically be two different classes of founder shares. So let's say the Class B shares, instead of representing the typical 20% of the post-IPO company, they may represent, let's say, 10 or 15% at the outset. And the additional class, the Class C, would basically only vest or be earned if they're, once you do the business combination, if the share price for the target stock exceeds certain hurdles over certain timeframes. And the benefit is that from the sponsor's perspective, even though they're potentially losing something at the outset, they have the ability, when you sum up the B and the C shares together, to potentially get 30% of the company if it performs well instead of the typical 20. And from the market standpoint, from the investor standpoint, it's better because they're limiting the amount that they definitely receive, and they have to earn the rest, and the stock has to perform. So that was something we were starting to see. There weren't a lot, but that's something that we may continue to see as an evolving feature in some of the SPACs. And then the last point I'll mention, just in terms of trends, is based on those numbers we were talking about earlier, in terms of the number of, you would imagine, D&O insurance policies that were being written, and I think a limited number so far of participants in the insurance industry that write policies on SPACs, coupled with a little bit of increase in M&A related litigation, we saw D&O insurance costs just exponentially increase to the point where it was forcing us to evaluate, as I mentioned earlier, the kind of previously tried and true formula for the amount of private placement warrants that needed to be issued. Now people had to take into account the fact that their offering related costs were doubling, or in some cases, tripling, because of rising D&O insurance. So that's been something that we've cautioned all of our SPAC issuers at the outset to get their arms around, so that we can figure out ultimately the amount of warrants that would need to be funded. Those were the key features that I was wanting to cover for the IPO portion. So now I'll turn the presentation over to talk about trends in or features that you need to worry about in terms of selling your company to a SPAC, or buying the target company.
Okay, thanks, Heather. Next slide, please. So at the outset, Heather gave a market overview and mentioned the unprecedented amount of SPAC IPO activity over the last year and a half, and that is translated into over 400 SPACs that are looking for an M&A target in the market currently. There's approximately $190 billion of capital poised to invest in M&A transactions. And in the first quarter, we were seeing multiple SPAC business combinations announced daily. Based on the recent SEC position on the warrant accounting, that has slowed considerably as SPACs digest the impact of the warrant accounting position and figure out what the next steps may be. I will say at the same time, we are continuing to see activity by SPACs pursuing business combinations. So that hasn't slowed down entirely. We saw a few deals announced in the last 10 days, and we have various deals that are ongoing in the firm. So this warrant issue hasn't put a halt to the market, but it has slowed it down. Next slide, please. Okay, for those of you who aren't familiar with the DeSPAC process, once a SPAC goes public, the cash is put in a trust for the sole purpose of affecting a business combination. And once the SPAC is public, the SPAC will go out and attempt to identify a target. And the method of identifying a target will likely come down to the sponsor's network and banker-led processes. That's what we're seeing for the most part these days. If you're a private equity, if you're a sponsor that's affiliated with a private equity sponsor or a venture capital firm, you're going to be able to attract deals from your network. And if you're a repeat player in the SPAC market, like certain of our clients, you're going to see every deal in the market. But banker-led processes have also become very common. Companies who are interested, private companies who are interested in doing a business combination with a SPAC are hiring investment banks to lead, what would be a typical sale process where the bankers go out to the SPACs, they negotiate NDAs, they seek indications of interest, and they determine a preferred SPAC based on that process. So we're seeing a lot of that as well. Once the SPAC identifies a target, you get into more or less a normal M&A process where you're negotiating a merger agreement or a business combination and related ancillary agreements that we'll spend a little bit more time on the next slide. And all of these SPAC transactions also include, sorry, you mind going back? So all of these business combinations also include a PIPE component where investors will commit to buy shares in connection with the transaction to bring additional cash to the deal. So that's something that is going on side by side with the negotiation of the business combination agreement. Once a deal has been negotiated, the parties will announce the transaction. On the day of announcement, the SPAC will file an 8K, which will include the business combination and other business combination agreement, other related agreements, and an investor presentation, which is designed to cleanse the PIPE holders or the PIPE participants who participated in the process. From there, the parties will negotiate, we'll draft a proxy statement and a registration statement to be filed with the SEC for the purposes of the SPAC stockholder vote to approve the deal and the various other actions that are contemplated in connection with the business combination, such as amending the charter and issuing shares and that sort of thing. Once the proxy statement and registration statement is declared effective and clears the SEC, it'll be mailed to the SPAC stockholders. A meeting date will be set, and the SPAC will prepare for the stockholder vote. 2 days prior, 2 business days prior to the stockholder vote, the SPAC stockholders are given an opportunity to redeem their shares, as Heather mentioned. That's obviously a critical date because if they exercise their redemption rights, the amount of cash in the trust goes down, and that has an impact on the deal. Again, that happens 2 business days prior to the stockholder meeting. The stockholder meeting then occurs, and assuming everything has gone according to plan, the deal will close shortly thereafter. Next slide, please. Okay, there's a lot going on in business combinations or DeSPAC transactions. There are various work streams that are quite time intensive and require a number of advisors. Just to touch on a few of the work streams, there's business and legal due diligence that goes on, and this is a critical area for SPACs because some SPACs have come under a little bit of scrutiny and pressure based on allegations that they haven't done an appropriate level of diligence. So this is an area that needs to be focused on in connection with your business combination. There's also a financial work stream that involves preparing PCAOB audited financial statements for the purposes of the registration statement. And we found that this turns out to be somewhat of a timing issue because many of the targets don't have PCAOB compliant financials. And so we're seeing a bit of a delay following the signing while that audit gets completed and the registration statement is ultimately filed. There's marketing that goes on, in particular with respect to the PIPE process, which I'll touch on a bit more briefly. And then you've got your normal documentation that you would expect to see in pretty much any M&A transaction. You're negotiating an LOI, you've got subscription agreements related to the PIPE, you're negotiating a merger agreement or a business combination agreement. The existing registration rights agreement will get amended and restated. A new post-closing charter and bylaws will be put in place, and their go-forward incentive plans for the combined company that will get negotiated at the time of the business combination, or between signing and the filing of the registration statement. And then you've got the S4 and the proxy process, which can be quite time consuming. And what we typically see is a separate team, at least attempting to work on the S4 and the proxy statement in parallel. So that can be signed as quickly after the business combination is announced as possible. And again, that depends on the availability of the PCAOB compliant financial statements. Next slide. So as I mentioned, the PIPE process has become a very important part of the process, and it can be time consuming, and it can have an impact on the deal that I'll touch upon a bit in a moment. But we just wanted to give you a quick overview of the timeline of a typical PIPE process. And again, this will happen mostly in parallel with the negotiation of the merger agreement for the business combination, but it generally takes about 4 weeks, and we're seeing most of our SPACs engage investment banks as placement agents to assist with the marketing of the PIPE, usually a combination of investors that the investment banks can attract and investors based on the network of the sponsor or the SPAC. But that's how you kick it off, by working with an investment bank. They'll reach out to an investor base for marketing meetings. You'll negotiate the terms and a subscription agreement. And then the commitment around the PIPE and the final subscription agreements they'll be final and executed at the time the merger agreement is signed. Next slide. Okay, so I wanted to touch on a few key considerations in DeSPAC transactions. And the first one is process is important. And Heather touched on this in her section, but these are real public companies with a board of directors, audit committees, all the requirements to be listed on NASDAQ or the NYSE. And I've had some interesting conversations with SPACs that have gone public, and they're surprised at all of the process that is required in order to get a deal done. And one thing in particular that folks lose sight of at times is that the background and history of the business combination is a key disclosure item in the proxy and the registration statement. You basically have to go through a chronology of the transaction in connection with the proxy statement, and that is one section in particular that the SEC focuses on. So the SPAC management team needs to regularly update the board on pipeline and live opportunities. We always try to involve the board early and often, all the way at the letter of intent or the term sheet stage, so they can properly vet the business combination and we can show a good record for the purposes of the background and history of the business combination. Advisors need to be actively involved as well, whether it's the law firm, whether it's an accounting firm doing tax or financial diligence, or an investment banker who's been hired to deliver a fairness opinion. And plaintiffs' lawyers are now active in this space. When we really got into this about 5 years ago, we didn't hear anything from plaintiffs' lawyers. About 2 years ago, we started to receive some letters, and now we're starting to see claims. And back to Heather's point about the rising cost of D&O insurance, it's directly related to that. Next item I wanted to talk about is that auctions are impacting SPAC economics. So because the market has gotten so competitive and investment bankers have been brought into the space to run a sale process or a DeSPAC process for their clients, the process has gotten very formal within the banker-led sale process. And SPACs are typically given a form of a term sheet to stay involved in the process and to use that for the purposes of bidding. And within that term sheet, there's typically a section that where founders are asked to let the company know how much of their economics they're willing to give up, whether that's a forfeiture of sponsor shares or warrants just outright, whether it's a transfer of sponsor shares to the sellers effectively, whether the sponsors are willing to backstop expenses over a certain level. So the targets are really focused on trying to reduce or limit the sponsor economics in these processes to avoid as much dilution as there could be from the sponsor shares. What we're seeing is many of the first-time SPAC sponsors are under a little pressure to win deals, and they're giving up more economics than the more seasoned SPAC sponsors who are staying away from that type of negotiation because they have a bit of a track record. Next slide. So the PIPE process is very important. The PIPE financing serves as important third-party validation of the transaction and the valuation. It's not uncommon in our experience for the valuation of the business combination to be reset based on early conversations with investors. So the investors will be wall crossed, you'll present the opportunity, you'll discuss the valuation, they'll come back with an indication of interest that may result in a reset of the valuations. And we've seen many PIPE transactions or many business combinations fall apart at the PIPE outreach stage or shortly thereafter if the interest does not get to the level of that the SPAC would anticipate. It's also important to get new investors involved in the opportunity, but I think SPACs also like to see a doubling down by existing investors, which can send an important message as well. These deals are public style transactions. That's not how we looked at them 5 years ago when we got into it. We were treating these as private equity transactions where we would be adjusting the purchase price for cash, debt, transaction expenses, working capital, but the market has very much moved away from that, and the deals are priced on an equity value now without adjustments at closing. The reps and warranties are given at a high standard. They don't survive closing, and there's no post-closing recourse in the form of indemnification or an escrow. And I don't see SPACs buying rep and warranty insurance any longer. We used to see that earlier in the cycle here, but we're not seeing that quite as much. And then timing of stockholder approval, that has also become an interesting issue based on some recent SEC guidance. Target stockholders can deliver a consent to approve the transaction at signing, but the stockholders who deliver a stockholder approval at signing cannot participate in the registration statement, so they would get unregistered shares on a private placement basis and be a party to the registration rights agreement at closing. Most of the market participants have welcomed this development, but some target stockholders are pushing back because they prefer to get registered shares and not wait for the S1 after the fact. Next slide. Okay, just to finish up with a quick overview of the timeline to give you a feel for what we're dealing with here. I think we've touched on most of the key events, but I would say for the most part, from initial kickoff to signing, and that will involve all the negotiation, the wall crossing of investors, the negotiation of the PIPE transaction, we would expect that to be about 60 days. You can tighten it up if everybody's motivated and you're not uncovering any issues. but that takes about 60 days. And then the SEC process through drafting the proxy and registration statement, interacting with the SEC, will probably take 60 to 75 days. Once you're cleared with the SEC and able to mail the proxy statement for the purposes of the SPAC stockholders meeting, you're about 20 days away from closing at that point. So that's a pretty typical timeline. You know, obviously there's variation based on particular issues in any deal, but that's what we would expect. I'll turn it over to Doug now.
Thanks, Kyle. Can you go to the next slide? So one of the threshold questions for a target company is why sell yourself to a SPAC? And SPACs have gone through a number of cycles over the years. And I would say until recently, in many cases, a SPAC was the buyer of last resort. So a private equity sponsor would run a sale process. It wouldn't garner sufficient interest or attractive enough valuations, and a SPAC would be hanging around the hoop and you would sell to a SPAC. And partly that was due to the development of the SPAC market at the time, which was largely backed by fundless sponsors and ex-CEOs of public companies and not really blue chip sponsors. In the most recent cycle, as Heather said, probably most SPACs are either backed by blue chip sponsors or other very sophisticated financial players. And so that has lended more credibility to SPACs in terms of the value that they offer target companies. The other two developments have probably been the development of the PIPE market, because the PIPE market has allowed SPAC sponsors to do bigger deals and also increase the certainty of getting deals done. And the last is that the IPO market for SPACs has migrated largely from hedge funds, where it used to be, to more long-term institutional investors like mutual funds and the like. And therefore, SPACs have become a more attractive alternative to target companies when they want to sell, particularly if what they're considering is doing an IPO or a sale to a SPAC. Many of our clients nowadays, when they're looking at selling portfolio companies that they would like to take public, they would run a dual track process to either do an IPO or sell to a SPAC. And you know, a SPAC does have certain advantages over traditional regular way IPO. Probably slightly faster to market in terms of the overall timing than getting a company ready for an IPO and going through the IPO process. Target companies can disclose projections in the offering documents for a SPAC, unlike in an IPO offering document. So you can market your SPAC off projections, which you otherwise couldn't do. And Kyle mentioned some of these, but there are bespoke economic terms that you can negotiate as part of a SPAC that you can't do in an IPO. In an IPO, the sponsor is typically negotiating with the underwriter as to economic terms such as the IPO price, the discount, which is pretty much fixed anyway, and negotiating with itself as to other terms such as post-IPO governance, post-IPO liquidity rights for the sponsors. And what negotiating with a SPAC permits you to do is it gives you much more flexibility in terms of being able to negotiate economic terms with the target company, with the company going public, and also terms related to post-closing governance and liquidity rights. Next slide, please. Next slide. Okay. So, you know, what are the key issues that target companies want to negotiate with sponsors? And obviously, you know, one is purchase price, and I think Kyle's already mentioned that it used to be that that SPACs, when they were buying target companies, would price the deals based upon kind of a closing date balance sheet formulation, enterprise value plus cash minus debt plus or minus transaction expenses plus or minus some working capital adjustment. And the market's moved away from that. So it's now, like Kyle said, more or less a fixed equity value and much like a public company deal. So probably in a minority of deals, you still see the kind of traditional closing date balance sheet purchase price mechanic, but it's a very distinct minority. So, one of the things you negotiate up front is it a fixed purchase price or a closing date balance sheet? And it seems like the market trends are for a fixed purchase price. Same thing with purchase price adjustment escrows. Those used to be more common, as Kyle pointed out. Those have largely disappeared. I think in the first quarter of 2021, less than 10% of the deals had a purchase price adjustment or any kind of escrow, whether for an indemnity or otherwise. So that's becoming pretty standardized in the market also. In terms of pro forma ownership, this is kind of interesting. There's probably a perception that the SPAC sponsor and the SPAC end up with a majority of the equity in many target company acquisitions. Given the size of the target company acquisitions nowadays, that's definitely not true. Most SPACs end up with a distinctly small minority interest in the target companies following the sale to a SPAC, often between 10 to 30%. The sponsor itself, which has the founder shares and the warrants, may own less than 10%. The target company is generally the largest. The target company stockholders are generally the largest owners of the SPAC post DeSPAC transaction, and probably the second largest is between the SPAC and the PIPE investors. The PIPE investors typically end up anywhere between 10 and 30%, and the SPAC would also. Another thing you negotiate is, how much cash do you take off the table versus how much do you roll in equity as a target stockholder, and it's a relatively small portion. One of the advantages of doing a DeSPAC transaction rather than a traditional IPO was that theoretically you get more cash off the table. But in the recent SPAC market, most target stockholders have been rolling their equity into the SPAC, and it's more or less around 15 to 25% in most SPAC transactions of the cash that's been taken off the table. So they're largely becoming equity holders, as we pointed out in the SPAC going forward. Another thing which Heather also mentioned was that one of the and Kyle also, one of the negotiations is around sponsor economics. You have the founder shares and you have the warrants, and the question is, do you forfeit some of those, or do you transfer the benefit of those to the target stockholders? That's often a big negotiation, and now some sponsors are trying to bypass that. They're using what Heather referred to as the alignment share structure. Example that is TPG. In their most recent SPACs, instead of they don't have any warrants and they just have 10% founder shares instead of the normal 20%. And the idea is that you'll make yourself a more attractive acquirer to a target business if you don't have to negotiate those things, and also you demonstrate to the target company that you're trying to align economics in advance, and you're trying to get the economics to the target stockholders closer to what it would be in an IPO, where there's probably a 6% underwriting discount on whatever amount of equity is issued in the IPO, and there's also some hidden discount because underwriters typically try to price IPOs at a price which will show some kind of bump for the IPO investors post IPO. So one of the advantages of the aligned share structure is it eliminates the negotiations on the sharing of the founder economics, and it also sends the right message to the target that you want to get a deal done with them, and that you're not going to be haggling over, how do you hack up the warrants, and how do you put earn-out conditions on the founder shares. And in a world where there are still founder shares and warrants and people don't use the aligned share structure, one of the issues you negotiate is earn-outs, and that's whether there's already an inherent earn-out in the warrants, because the IPO price for SPACs is typically $10 a share, and the strike price for the warrants is $11.50. So there's got to be a 15% appreciation before the warrants are in the money. So there's already something of some kind of earn-out structure in the warrants, but sponsors do frequently agree to earn-out structures on the founder shares, just again to align interests with both the target stockholders as well as the PIPE investors. And as Kyle pointed out, the PIPE investors are very important here. The PIPE investors really, in many cases, make or break the deal depending upon the level of demand that they have for the equity. Another key issue that sellers and sponsors negotiate is lockups. Even if the target stockholders in many cases receive freely tradable shares in the SPAC post DeSPAC transaction, no one wants them to flood the market with their equity immediately. So typically, they would agree to a lockup. 6 months is pretty typical, and the sponsor would have to agree to a lockup also. And the sponsor lockup is typically 12 months. I think Kyle already hit upon indemnity. Indemnities have gone the way of the dodo bird. You see them in less than 10% of the deals. As Kyle said, the market has truly migrated to a public company type structure. And then rep and warranty insurance, Kyle already hit upon this, but insurance companies have struggled with SPACs. So even if there was interest in taking out a SPAC policy, it's difficult. For instance, who's the named insured? Is it the SPAC sponsor? Is it the pre-DeSPAC transaction SPAC stockholders? That's very difficult to do. Is it everyone? So it's very difficult for the insurance company to get comfortable with determining who the named insured is. And if you try to include everyone, the premium doesn't make sense anymore and the policy doesn't make sense. And given the fact that it's a public company style deal, also the materiality thresholds and the reps are very high. And if you're asking insurers to scrape those materiality qualifiers for purposes of indemnity claims under the insurance policy for breaches of those reps, it's pretty hard for them to swallow, just given the fact that the materiality threshold in these kinds of reps are very high standard. I think we're starting to get near the end of our time. So we do have a COE code. So the COE code for everyone who wants COE credit is CL2115. And I think we're going to go to Q&A.
Yeah, we just have one question that I think both Kyle and Doug have answered already. It was around the time of the DeSPAC, that there was a lot of discussion related to dilution, relating to the sponsor's interest and explaining the interest, the ways that the interest can be diluted. I think you guys have both covered that already in your discussion.
Yeah, and it's kind of evolved over time. As Kyle said, frequently, if you're a SPAC which is participating in a process, you'll receive a term sheet, and one of the things in that term sheet will be an exhibit where you're supposed to indicate what you're proposing in terms of forfeiture or transfer of founder economics to the target stockholders. And that's become very common, and that is something which is heavily negotiated because the target stockholders do expect to share in the founder economics. And as we mentioned, a lot of sponsors are trying to short circuit that discussion. I mean, their thinking is if we're going to get 20% founder shares initially, but we're probably going to have to give up 50% of them, why not just go out with a 50% ask initially and get to the finish line quicker? Cloud, did you want to add anything on that?
No, I think you covered it.
Okay.
Apologize, there might actually be a few more questions that for some reason I'm not able to see.
Heather, if you if you put your cursor on it, the question will get bigger, like at the bottom.
Yeah, just for some reason I'm only seeing the first question.
Heather, I can take one of them. There's a question about whether DeSPAC transactions are typically thought of as mergers, or can you do other structures? And I think it obviously depends on the makeup of the target stockholders. We're seeing a lot of growth stage companies go through a DeSPAC transaction where there are a number of venture capitalists in the stock, as well as significant number of employees and other stockholders. And in that case, by necessity, you do a merger. We've done direct stock purchases. I think the one structure we haven't seen is an asset purchase. I think that would be a little bit more difficult to pull off, but I don't think it's prohibited in any way. I think for the most part, we just see direct stock purchases or mergers.
Were there other questions, Heather?
Yeah, do you want me, Heather, do you want me to read, or are you
Yeah.
having trouble seeing?
Yeah, for some reason it's all collapsed and I can't see.
No, it's okay. It's okay. And tell me if we've already answered this. At the time of DeSPACing, there's a lot of discussion related to dilution of the sponsor's interest. Can you explain the ways interests can be diluted? Did we already do that?
Yeah,
we
that's
did
the
that
one I
one.
was able to see.
Okay. Do you expect, how does the SEC evaluate something is an equity or a liability, and how does that impact the economics of a SPAC?
Yeah, so there is an accounting standard that the SEC referenced in their statement on warrant accounting, and there are criteria and features of the terms of the warrants that will guide the accountants whether it's liability accounting or equity treatment. So it's really a function of this accounting standard that everyone is evaluating against the terms of the warrants.
Okay. In what percentage of SPACs do the target company shareholders end up owning a majority of the shares of the merged public company?
I think Doug touched on that in his presentation.
Nowadays, it's largely a majority, isn't it, Kyle?
Yeah, I can't remember the last deal where the target stockholders did not constitute a majority on a post-closing basis, and based on the valuations that we're seeing in some of the SPAC transactions, the pre-closing target stockholders can hold as much as 75 to 80%.
Yeah, it's kind of a curious dynamic actually, because if you think about it, the SPACs are backed by blue chip sponsors nowadays, you know, Carlyle, Apollo, TPG, or whoever, but they typically end up as very small equity holders in the combined company, and they often have very little board representation. Often, you know, they just have one board seat. It's kind of a very interesting dynamic.
I'm going to go with one last one. Are you seeing the entities that put up the risk capital or a portion changing gears in very recent days with slowdown?
You mean in terms of the sponsor for the funding of the private placement warrants?
That's all
No.
I got.
Yeah, no, I mean, there is sort of this, you know, there's a formulaic approach really to funding the needs that the SPAC has. And so, you know, that money has to come from somewhere. It can't come from the IPO proceeds. Those have to be in trust. So, you know, the sponsor really is still required to put up that risk capital. It's now potentially higher than it was because of the increased D&O insurance liability or insurance premiums, but effectively that still has to happen.
Okay, and one last one. Do you see PE-backed sellers into SPACs?
Yeah, PE-backed companies sell to SPACs all the time.
Okay.
They often, their decision is, particularly with a company they want to take public, do I take this public or do I sell to a SPAC? And they run dual track processes for that.
So we are right up against the hour. Brian, do you want to carry us out?
Thank you, Kyle, Doug, and Heather, and our Heather too. This thing ends up looking easy because our Heather puts a ton of work into it to make it look easy. So thank you, Heather Nielsen, the Weil team, and look forward to our follow-up on this, and also our question about when you're going to feel comfortable coming back to live events. So thank you very much. Thanks for your support. As always, Dimitri and I are very happy to keep running these events. So
Thank you,
everybody.
guys. I really appreciate it.
Thanks, everyone.
Thank you. And thanks,
Bye.
Kristen, for all your help if you're still on the line. Thank you so much. Bye, guys.
Bye.
Bye.